Franchise Secrets podcast with your host, Eric Van Horn. And today's guest is Geoff Seiber. And I've known Geoff for a while in franchising, and I know a lot of people that know him. He's just one of these guys that's super connected in franchising, founder of a company with his wife called FranFund, and does a lot of lending out there in the franchise space. And so I want to get into it with Geoff, get a little bit of his backstory, how he got into franchising and into lending. And then I also want to go right into the state of the industry and the financing, how people are getting money now, how he sees it and what he sees in the future. And we'll also get into some of the things of, like, you know, if you're thinking about investing into more businesses, or maybe your first business, we're going to talk about like where you are in your life. If you're the beginning stages of business or more of the mature stage, and how you should be looking at lending as a tool at the different stages of your life. So Geoff, welcome to the show.
Well, thanks, Eric. It's kind of fun to be here.
Yeah, so I'm glad. I've been trying to get you on for a while. You're not easy to get, especially when planes like don't land when they're supposed to, and things like that.
Yeah, unfortunately, American Airlines seems to not really have a schedule these days. They have the one they print, and then there's the one they run. So
when are you getting your own jet?
Yeah, that would be a life goal. That's a life goal.
Awesome. I love that. Well, like, I know who you are, but for the people that don't know who you are, and there's probably very few in franchise that probably don't know a lot about you, but like, tell us a little bit of your story. Who are you?
Hey, Eric, I've been in franchising pretty much all my adult life, or even my kid life, starting with being a delivery driver for a franchise of Domino's Pizza, franchisee, when Domino's Pizza had 300 units. And I progressed through that plan, left school to do that. All my professors told me I was in grad school, told me I was nuts. But the franchisee told me, you will never make any less money. And you know what? He proved out to be pretty accurate in that goal. And I certainly have not looked back and regretted that move into franchising. I then went to work for corporate Domino's, became an area vice president, worked my way up through the path. And that was at a time when we were very young in that company, and it was kind of a ready, fire, aim company. And you got to do things if you raised your hand. If you raised your hand, worked hard, and they let you do kind of whatever. We were a little bit scattershot. From there, became actually a franchisee of Domino's for a while, left that, went into my own work in the financial field, working on repossessed things from banks. I mean, when we had the first downturn back in the S&L crisis, there was a lot of distressed properties that I would pick up and flip and move them back into a loan performing situation. That took me to come into Fort Worth. We went back to work for Great Clips and was involved in their massive growth that went through that area, and then met Jeff Elgin, who I think a lot of you know, and Jeff and I co-founded FranChoice back about 20 years ago at this point. And then that evolved into needing a way to finance the placements that were out there. The franchisors at that point were paying very little attention to that. And we started FranFund, and we've kind of never looked back.
Tell me a little bit more about, like, from the pizza delivery guy to franchisee, because I'm a big believer in, like, you don't get a job just to get a paycheck. And, you know, when you get into an organization like that, I'm sure in the beginning, 300 units is a lot of units, but compared to where they are today, you know, that's nothing. And like, I look back at my journey, and I was involved with a franchise, and I think we had maybe 100 units. And I thought that was really big until we hit 1,000 units. So what was that like? What was your mindset like? You know, go back to like when you were a kid, and to just your mindset of like, this is a job, but this is more than a job, and how you progress through the ranks.
Well, I think back, you know, the franchisee that I had in the Raleigh-Durham Chapel Hill area that I worked for as a driver and then as a supervisor and those sort of things, he was a very sharing, in that he would set goals for everyone at every level, even the employees across the thing, where you had different goals you wanted to meet. Everybody knew what they were, and everybody pulled for those and toward those. And that was very attractive to me, even as a grad student going through college, that you kind of got ready for the goals. And the Pepperoni Press back then, which was Domino's, internal newsletter, they would publish literally from first to last the volumes of the stores from the week before. And my franchisee, we were he had several stores that were in that top 10, but there was a front page where that they always did it. And then there was several pages that would be towards the back. And his mantra was, if we're not on the first page, I don't even want to talk to you. So if you're not able to crack that page one, guys, then, we really need to get busy. And everybody knew that. The drivers knew that. The managers knew that. The drivers knew that they charted delivery times and customer experiences and mystery customers and all those sort of things. And those were posted where that everybody in the stores and in the units got behind that. You always wanted to win. And it was also, in the college stores, we had NC State, Duke, and North Carolina. It didn't matter if it was tiddlywinks. You wanted to beat the other team. You wanted to beat those guys. So it was really easy to kind of get the crews around those goals. But so that was the start. And that's the way Domino's was then. As I said, it was kind of a ready, fire, aim situation where that in order to be a Domino's franchisee, and it's still this way today, you have to successfully run a store for a year before you can apply. And what that's done is it made their training program and their consistency across the board very easy to put all across and to use the kind of scattershot way that they did, which was just campuses, military bases to start, then came back in through the residential area by having experienced owners who were managers that had seen the problems, seen the things, knew how to do this, knew how to do that, knew how to train. So it made the training very, very modest, and it allowed Domino's to have a very low franchise fee, which was basically the cost of getting all the paperwork done and filed. They wanted those store managers to put their money straight back into the unit operations. So it worked very successfully.
That's interesting. I mean, that's why, McDonald's does the same thing, I believe. You have to, how long do you have to work at a McDonald's before you can even be invited to apply?
I think it's 6 months plus before that they want to run you through to see if you do that. Chick-fil-A does a very similar program with that. There's several concepts that have done that. At first it really hinders your growth, right?
That's the disadvantage. That's why franchisors don't want to do it.
But as you move forward, it gives you a bench that's a mile deep in order to find your franchisees from. And at the time, way back in those ages, there wasn't the internet. We could never do anything like this. Everybody had to go somewhere to be trained, and everybody. Well, if you can take all of that information transfer out of the equation and put it just where that they've done hands-on in a unit for that period of time, it makes the whole thing flow better.
Well, I think kind of the evolution of that, or at least what I do in that, is like this week I have one of my operational partners is at training in Orange County, California, and I set up time for him to meet at least one, maybe two stores that are up and operational, so he can spend a day with them. And I remember, growing up in franchising, 15 years ago, and I would do that myself. And I would send my managers to go shadow, successful operations. And so I can see the value in that. But yeah, it does hinder growth. But we're getting off topic. But that I find that interesting, a brand that does that. Well, you're the lending expert. I know you do so many cool things. Later on, we're going to get into it too, some of the unique things that you're doing with people that have lots of money and basically family office type stuff where they are partnering you. I'm probably using wrong terminology here and you'll correct me, but there's some unique things that you're doing that we're going to get into later. But for now, so here we are, going into the fourth quarter of 2019. What do you see happening in the industry, in the state of lending and franchising?
Well, I think it's been a very neat run over the last several years, and a lot of that was tied to there was a lot of anxiety before the election. Now we could all argue there's been a lot of anxiety since the election, but in the business community there was a lot of anxiety going into 2016. On the business side, it's kind of been really good for, I think, small business ever since. The banks have had a little better direction and some regulations have been lifted from them. It's allowing them to feel a little bit more comfortable making higher risk lending decisions. And then there's been a lot of change at the SBA, the Small Business Administration, again, for clarity. I don't think there was any real change of direction or any real change of end game from the Obama administration to the Trump administration. And there's pluses and minuses with both that we had, but the regulatory,
Want to get into those pluses and minuses? Is it fair to get into some of those pluses and minuses?
Some of those things. Well, I think
if it's relevant,
it's relevant a bit. We were headed towards, I think, even more regulation in the SBA itself, and what they were asking the banks
under Obama,
and that kind of eased off in the Trump administration and kind of got cleaned up. Now, I will tell you, a lot of people think that Trump just threw all the regulations out the window. He did not. Far from it. But they have tightened up on things that I think that I personally believe were more important, and relaxed some things that to me were just that kind of excess paperwork for the banks to have to do. They are holding them more accountable in a lot of ways. They're holding them to certain standards that used to kind of be winked at, which I think has cleaned up some things. I also, a Democratic administration and a Republican administration, they both have different ways that they look at the SBA, and it may surprise you that a lot of times it's a Democratic administration that is the more forthright and more pushing things down line than a Republican administration, because there's a lot of conservative legislatures that do not think that the government should be backing some of the loans that they do. In other words, the bank should be able to take that risk on their own. And because the SBA is, as you know, I don't know if everybody that's listening knows, the SBA is really kind of like an insurance policy for the bank. Mm-hmm. They'll pay off 75% of that loan if it goes bad and it's been done according to standards and meets all the guidelines. If there's a default. Well, if it's a really good loan with a really great borrower, you can take the position of the bank should take that risk on their own. They don't need the taxpayers' money to do that. When it's a Republican administration, you see much more of that come to the forefront. In a Democratic administration, you tend to see, well, yeah, we'll do all those, but now we want 8 inches of documentation in a file in order to do that. So it becomes a little bit, there's kind of a yin and a yang there between the two. But I think we were in a lot of gray as we went into 2016. That's been cleared up and still clearing. I mean, the new regs are still coming out, as to what's going on, and about the time we'll get the direction we should be in. Of course, they'll want to change it all again, but it has been good for small business lending, and small business lending has performed, I think, which is part of the real key here. In that, I believe that the not only small business lending overall, but franchise space has incredibly performed, which is leading to other opportunities for people. We do a lot, Eric, in the startup space. We do the highest risk, help people through the highest risk part of their lending journey, if you will, which is that.
What does that mean? Like, what is
and, high? I think that's
what's high risk.
Pardon me. I'm sorry, I missed you.
What's high risk? That's fine. I think we have a little bit of a delay, and when I'm going to talk, we'll just edit some of that out real quick. Hold on. Let me just, let me get my timer in here.
Yeah, I lost you there for, sorry. I could see it moving, but I couldn't hear you.
I'll just do this when I'm going to like pipe in, you can just pause next time. So I'll just kind of do that.
Okay.
But I was going to say, like, so Geoff, what's considered high risk? Like, you do a lot of the high risk. I'm assuming that's like young franchisors, people that don't have business experience that are getting into business. So what would you consider that high risk, and SBA or the banks consider high risk lending?
Well, there were several things that changed that risk quotient a lot. You're on a startup franchisee, first time he's been in business, first time he's left a corporate job, he's left a different environment, and so for the first time he's going out on his own. I mean, logically you go, okay, that's up the risk curve there pretty good, but what you can mitigate that part of the risk curve with is if they've had prior experience within that field. But sometimes we don't even have that. Sometimes that's not the right thing. But we know this is a solid person based on their resume, based on what they've done in the past. They've been successful in things. They pay their bills on time. So, we can mitigate that part of the risk. The second is the business they're buying. And as you touched on, a franchisor who is young is also higher up the risk curve. If I've got somebody that's been in business, franchisor that's got, it doesn't even have to have 1,000 units. He's just got 300 units, 400 units, but he's got 10 years of experience, and I get that FDD, I can run through that and go, they've got their act together here, right? But if we've got a franchisor who is new to the game, has very few operating units, even if the results are spectacular, the risk there is, yeah, it works right now in this economy with these people, with this thing, with the way they're doing it. But what happens when they have more competition? What happens when they try to expand beyond where they are? Are they truly regional? Is this a great snow removal operation in Minnesota that they're trying to sell in Atlanta?
So as you're saying that, I've had conversations with bankers about this type of stuff, and you're like, the things coming out of your mouth is what would come out of a banker's mouth, because the way that they view risk is so different than how an entrepreneur views risk. And we bet on ourselves, and we, and there's a lot of that. But the banker, they just look at things on a spreadsheet, and then they just have this risk tolerance that is very different than what an entrepreneur does. So like, there's someone that's out there that's thinking about going into this, then they're thinking, gosh, I don't want to be that high risk. If you're getting an SBA for the first time, you've never owned a franchise before, you're probably going to be in that high risk category, because any franchise that is 300 plus units probably doesn't have any territory available for you to buy. And so, that's where you kind of have to put on, do I have what it takes to be an entrepreneur? Because there is risk in that. And then to go, that's why it's so important to go to somebody like you, Geoff, is to help them get to the right lenders that have an appetite for that type of risk. And can you go into that? Like, why is somebody better off calling up FranFund and working with them to get an SBA loan, or should they just go down to their local bank, whatever that is, and apply for an SBA loan? What's the difference between those two scenarios?
Well, there's several, and I think you hit on one of the main ones first. Is you have to know banks who understand higher risk lending, and I'm not, that are comfortable. Then their credit committees and their policies are open to that. And there are several of those banks out there, and several of them that play on a national basis. But those aren't going to be the banks, even that bank, even if you, we can use Wells Fargo for an example. Wells Fargo has a situation where they can, in fact, do higher risk lending, and they'll do certain deals with certain brands. You're never going to get there if you walk in the front door of a branch and go, I want to do this. You're not talking, it's a whole different part and a whole different segment of the bank. But what will happen at a branch, whether it's Wells or anybody else, I'm just using Wells as an example, they'll always tell you, oh yeah, we'd really like to see that. We want to be that. They don't ever want to say no. They're out recruiting loans all day, and somebody walks in off the street and says, hey, I want one. They're going to want to see it before they tell you no. Even if inside they know we're most likely not going to do this, they're going to say, sure, let's get started.
There's so much truth to that. Like, whenever I'm talking to somebody, or I have to remind myself every time I'm going to get a loan, and I talked to my business partner about this earlier this year. I'm like, hey, we're going to get promised the world, and there's probably going to be things that come up. They're going to oh, well, there's this one thing, there's this one signature. We're not going to do this. And to the entrepreneur, that's a really big deal, what you just said. So you're 100% right.
Yeah, they're always, the business development side of the bank is always saying yes. The actual credit committee is not always saying yes. And so there's a thing, and they, and what happens is, and what unfortunately happens is, somebody goes there for their business and they want to do, they have a great plan. They have a plan that could be banked somewhere. There is a place for that deal, and they get discouraged when they go someplace where they turn them down, and they should not. They've just gone to the wrong place. They've gone to people that really don't understand what it is that they're looking at, or understand what the ways are to make that happen. And that's frustrating sometimes for us when we actually meet with those people afterwards. Is the first thing that they have to know is that they're bankable. They're a good credit. There's a lot of good here. This all works. Don't be so negative. Don't think because they turned you down that there's something wrong with this. Yep. It's just that they don't understand it, and they're not playing in the right ballpark. So
one of the other things that I've noticed is there's certain banks that get comfortable with certain franchisors, or certain industries, whether it's health or beauty or fitness or home services, and they get comfortable within the industry and they get comfortable with different specific brands within the industry. So you go to your local bank and they are going to look at you like, yeah, bring us the business plan, which is not an easy thing to put together, but give me a business plan. And they don't know anything about the business. And they're going to, just have a million questions for you. Or you go to someone like yourself and they send you to a bank that has experience. And like, oh yeah, we love franchise XYZ and we know a lot about them. We've done X amount of their loans and X amount have performed. And so now it's like, welcome to the family. Let's check off some things on our list. Is that?
That's very true. There's and that's very accurate in that there are certain banks that have more of an appetite for certain things, just like there's an appetite for startup, and some really good, excellent banks that we use for round 2 or round 3 with somebody with the same brand won't do a startup. That's just not their thing, but they'll give us really good rates on units 2 and 3, right? But the startup group is there. But say there's a group that likes pizza, or they like beauty, or they like hair, or whatever. They get comfortable with that model. They know it. They understand it, and they can look at those things really quickly and make a very quick decision. The only bad part that we have, or the other further caution that you have to think of down the line, that I mean, I don't even know if you're aware of what we do on the to kind of keep that all in balance, is you have to watch what a lender's total portfolio is and what any percentage of that industry or of that particular brand is in there, because the overall chief financial officer of the bank will then come in and go, not the credit officer, but the financial officer will go, okay, we've got enough of this or that. So we try to find several different national lenders that will work within certain parameters. If there's a concept that's expanding rapidly, we'll try to place that in more than one bank, so that we always are balancing that up in tandem, so that we certainly have additional lines, additional things to use. We don't like having just one sole source.
Well, I did know about that. I may not look like I know a whole lot about this lending stuff, but I know that from experience.
From being there.
Yeah. And not on the negative side, but just with a bank that had lent us a lot of money, many millions. But they were also very transparent with us on how stuff worked. And so I got to understand a lot of inner workings. If I didn't have a transparent banker like that, and I was working with the president, I wouldn't have known
how that works.
Yeah.
And so sometimes people get turned down. They don't know how in the heck did I get turned down? It had nothing to do with you. It has to do that they're going, I have enough pizza right now. I just don't want any.
Yeah.
It all performs, but I just don't. I've got to get other stuff in there. And so we'll try to help them balance the banks that we're tight with, or that we do a significant amount of business with. We'll try to help them keep their portfolios balanced, because it all kind of runs off a percentage too. It's not like a total dollar amount. So if we can build up other parts of the franchise portfolio with other things, we can get more capital released for some of the other brands that we had done with them before.
Any last things on SBA? Because we could spend a whole podcast on SBA, but I want to get into some other things with you.
Well, I think that there's so many people that are afraid of SBA. All they hear about is all the negatives and all the work and all the stuff and all those things. And all of those things that do exist, or there wouldn't be that stereotype, right? But
Yes.
But they can be, I guess the best word is mitigated. If you're using our company or a company like us, we now have where, they fill out the form, they fill out that information one time, and we populate all the SBA forms. So instead of sitting there at your kitchen table at night, spending 5 hours filling out all these forms, where you're seeming like you're putting the same information in, we're able to do that. We're able to transfer that information now directly to the banks. Where, when you get to a certain volume level with these guys, they start to exchange information much more readily. It doesn't mean we don't have all kinds of pauses in everything to let the computers catch up and make sure we're not bad guys, but it still can transfer, making that process a lot better. And our packaging team here, who is awesome, they know things that they know stuff that I have no clue about when it's going to Sally at that bank, it needs to be like this. And when it's going to Mary at that bank, it needs to look like this. So even all of those little nuances that hold things up, we tend to breeze right through those. So it can really help that. And the newer guys, as you know, have fear of everything. Like, oh, it's this, oh my gosh, if it's taking them that long, there must be something wrong. And really, a lot of times it's just that the paperwork's slow, and we try to take that out of the equation.
There's another thing that I'd like to get into with you, get your opinion on. It's because a lot of people have this mentality, like once I'm approved for the loan, then it's done, I'm approved. And they want to use that SBA loan to pay for the franchise fee. And you are not using the SBA loan to pay for the franchise fee. And correct me if I'm wrong here, but SBA loans are, you can get like pre-approved and you're ready to go, but you have to have a signed lease. And there's a document that the lender and the landlord have to sign to make sure that the collateral is assigned properly. And then once the lease is executed, that's when you can start to access the SBA money. Now they allow you, like say you paid $50,000 for a franchise fee, that can go against your 20% or 30% down in the SBA loan. So then you'll be accessing money sooner. But do you ever run into that with somebody that just doesn't know that?
Yeah, that is one of a typical tripping point. One, the franchise fee can be a part of the equity injection, and on a startup, again, if we go back to our discussion earlier on risk, as that risk curve goes down, one of the ways to mitigate that risk, to have a bank want to lend money to you, is to put more in yourself. And so a good rule of thumb on a startup business, first-time business owner, is 30% equity injection. If we can do better than that, we will. But rarely, if it goes further than that, and the needs further, they're likely not to do the loan anyway. I guess if they won't do it at 30, they're not going to do it at 50 because they think there's something wrong there, right? Yeah. And then we'll negotiate back from that based on the characteristics of that particular deal. So, but with that, in order to fund and rebate any of those dollars, or to add any of those dollars back in for working capital, or any of those expenses that may come up in the interim, that lease has to be executed. Because they need to know where that money is going, and that there's actually a place that it's going. And so we work in tandem with the franchisor or the franchisee, depending upon the relationship, but to make sure that we get that lease there as quickly as possible. That landlord waiver you're referring to is always can be a sticking point with certain landlords. The very, very sophisticated ones will have their own, of course, that they like to throw down, and we can usually get the bank to sign off on those. There might be a little tit for tat that goes back and forth on that. But where the bigger problems come from, quite honestly, a smaller guy that owns 2 or 3 centers, and he has one, or he just doesn't do them. I just don't do those. Well, that makes it a little more negotiating point. And what I can say is that we do tend to get involved in that with the landlord, and as a third party, not even the bank. We're not the final guy, and we're not the franchisee. We can sometimes work that to a place that makes sense, because landlords don't like to give up anything they don't have to, and so that needs to be talked about right up front with a landlord, that you're going to need that if you're doing an SBA loan. And all it does is release the collateral to the bank, release the collateral to me if there's a problem, where the landlord just doesn't put a padlock on the door and go, okay, now I'm in the pizza business. Well, yeah, you can be if you pay me.
Yeah. And I've had a number of different loans, and that's always, sometimes it doesn't, there's no disagreement with that, but I've never had that stop a deal from happening, at least getting signed. And so, it just, a lot of education needs to happen, or some education needs to happen when you have that smaller landlord. The big banks, the big landlords, they know where they're going to eventually end up, and it might take a couple of rounds to get there, but they'll get there. Well,
exactly right. And the only caution there before we move on, Eric, is that you need to do that before you sign the lease.
Yes.
It gets really hard after you've executed the document to go back and go, oh, by the way, I need this. Yes. Well, you've lost any leverage. Yeah.
Yeah.
Get it done.
Let's shift. We just got a few minutes left. I want to shift into like the life curve on people buying a franchise, lending, and your whole philosophy around that?
Okay, there's a kind of a process of thought that goes into what you're doing with your life and kind of your life run and where you are in that cycle. And there are certain investments or certain things that you do earlier in life when you can tolerate more risk. You can take more risk. You have plenty of time to fix that if something goes awry. And then there are things that after you've accumulated wealth that you tend to move toward in order to protect that wealth, to protect what you've accomplished and not put quite as much of it at risk. It's a typical, it's something you'd have with your Merrill Lynch, BB&T, Smith Barney discussion, right? And they're usually talking about things like stocks, bonds, how do we do in mutual funds? What are we doing with single stocks? They're going to throw all those sort of things and kind of put those into those same type of buckets. But I think you can utilize that across all of the investments you do in life. And part of that is one of the few things that I've ever seen that actually crosses into both buckets very easily and readily is owning your own business and putting the right financial structure and debt structure in that will allow you to both have high growth, and then as that business changes, it's also changing right along with you into becoming something that is protecting your wealth and your overall life curve. When most people look around and they go, "Ooh, that guy's made it, or he's in the big house, or he's doing this, or he's getting to go on vacations, or he's really able to do things for his kids or for the passions that he has," those are business owners.
Mm-hmm.
And for the most part, those are the people that tend to be looked at. And what's happened is they've moved through that cycle to be able to now protecting that wealth and being able to do things outside of the business with that. And I think, that rolls into our, the other product that we have, which is, leveraging your qualified assets, your retirement, what people call their retirement assets from another business as they move into this, is using some of that portfolio in putting it into the business helps you down that same curve. In other words, it's just one of the investments in your qualified money plan. And it makes a lot of sense to either use that for your equity injection, or as you roll out of the business later, all of that money is sheltered in a qualified money situation, and you only pay taxes on the stuff as you draw it out. So there's a lot of good things that you can do in that area as well.
Has that changed over the years, the 401k, and talk about the complexity of that?
Well, I think it's very important that you always need to do it right. And as you will see through various administrations, various times of points of emphasis with the Internal Revenue Service or the Department of Labor, they will push on various parts of that. This whole law has pretty much been in place since 1974 without any major significant changes as far as the structure that we use, but it's still, there are certain points that you always need to make clear depending upon kind of who's running the show. And we stay on top of that with our clients throughout the entire process and in their third-party administration work going, as we go from there. So yeah, the last day of filing yesterday was October 15th is the final filing day for the 5,500 forms. And
I signed at the end of the day.
Yeah. Yeah, and I have an exhausted staff today. So, everybody was up late last night. All of those guys like me who turn their stuff in late and still expect it to be done on time. Yeah, we had that.
What is new that you're doing or different or unique from the standard 401k retirement and SBA and conventional lending?
Well, here's what's happening. And one of the things that, again, maybe we should talk about a little bit with your folks is the loan we put in place for that first unit it's never going to go to term. I mean, I don't say never, but most likely we're not going to have that loan go out 7 years or 10 years.
What do you mean by that? Like, why?
Because you're going to rebank that.
Yep.
As you move, if we go back to our risk curve analogy, as you become less risky, there are banks that are going to want to take that debt.
Mm-hmm.
And they're going to take it on better terms than you had to take it to begin with.
Yep.
And so, your operating bank, if they see that you've now got 2 units and they're thriving, they're going to be saying, all right, I'll help you do with the third one. and we won't even have to do it SBA, and I'll go back and take those other two out, and I'll drop your rate 1.5 and we'll put it on a new 10-year term, and all of a sudden you're looking around and going, wait a minute, I'm paying less per month right now and I have a free store. My third store is basically free. I mean, those are the type of things that happen as you work down the success curve. And I always caution people as they start to roll out their Excel spreadsheets for 10 units over 10 years, and they keep using the same math on the debt load. And I'm going, guys, that is going to be so different. There's going to be so much more profit there for you as you go through that. If you meet anywhere near the numbers you're putting in here, your debt will be entirely differently structured.
Yep.
And
I've lived that too. I mean, this isn't just theory. I mean, you see it all the time, and it may sound like you're just talking like that. And it's not theory. I mean, you see it all the time because you're watching the paper go back and forth. I've experienced as an owner, banks coming back, and the banks want to do that. Like
absolutely.
Yeah.
The interesting thing is, and what protects banks, especially smaller banks, from that are in there are that you can't rebank an SBA loan with another SBA loan, because, and the government's rightful position is, if you, a banker, Mr. Banker, think this loan is good enough to change it, then take it. But it's also protection for the banks that make those initial credit decisions, that take that risk to at least make some money back on it, to make money back on having taken that risk. Or you would have the Bank of Americas that just would sit back and wait until somebody was 2 years old and go, okay, now come over here and I'll drop your rate 0.5 point and still write it under the SBA, right? They have the massive amounts of money to do that. They'd never do a startup. They would just do, wait for 18 months and then come and see me. But what's really neat is when the first bank that does it will normally do your second unit, because they believe in the concept. Pretty easy to get it done there. Third unit, they're likely to do if you're successful, but by third unit, we may want to look at something else. We may want to start, or at least planting the seeds for something else. In other words, making sure that your accountant's putting things in the right way, that your business plan is still there, that you haven't just filed it and never followed up and never continued to update it. Those are the type of things that would allow us to then go shop money for you. And that money is coming from, as you said earlier, some of the big private equity plays. I mean, huge, massive equity plays from insurance companies, from a lot of insurance money's coming back into the marketplace. And there's a lot of, on the West Coast, there's a lot of tech guys that have a lot of cash, and they're looking for anything that's creative that they can put onto a computer and try to do it that way. So, and so there's a lot more money coming in that is not traditional bank money. It's coming into the space right now, which I'm not sure where that all leads us. I just know that all of it is good. All of it is good for the small business owner. If the economy stays strong, where everybody's looking for ways to make money on their money, it's good for all of us.
Well, this has been really good. And I know, this is just the still surface level stuff. Like, I could have gotten a lot deeper into a lot of this stuff, and, maybe we'll have you on, or maybe we'll bring on Sherry, your other half, and she can talk about some stuff as well. Maybe that's it. Maybe we just go deeper into some of the things, some of the nuances with this, but I love what you guys do over at FranFund. I know, personally know people on your team, and you bring some great people, like our friend Shirley is there. And you've had, and you've done, just a little plug for you, just who you are. I mean, you had some really good people like Heather that were on your team, and you did to her what was done to you, and you let her, go into other areas in franchising and further her career. And I do the same thing. So I see that. I have a tremendous amount of respect for you for doing things like that, and just the things that you've done in the lending space within franchise. And so thank you for coming on and being a guest today. And would you have any last bits of wisdom or advice for anybody out there?
Well, I would say that, as with anything, if you're looking at the financial space and looking how you're going to fund your business and what that means, don't let it get too confusing. I mean, as you're working with other people, just like your lawyer, your accountant, your consultant, your franchisor, bring someone into that fold, especially early on, to make sure you don't go down the wrong path, and to help you get down the right path, and to be looking beyond getting that first deal done. I mean, because the way we structure the amount of collateral we may have to pledge, you say, hey, somebody did that and they got me a quarter of a point less in rate, but they literally took every bit of outside collateral that you had. That was not a good deal. Because as I said, if you're looking at only the course of you're likely to be in that loan 30, 36 months, and you got a quarter of a point difference in your rate, and you look at that so for $40 a month, $30 a month, I pledged all of my life away, and I'll never get unit 2 open. That was not a good deal. Let's look and see why different structures might be advantageous for people. And I just say, go find somebody that you're comfortable working with. Always be honest. I mean, that's probably the biggest, I guess, if you're looking for the one that tell me everything.
Yes.
Tell our staff everything. I don't care how bad it is, because we can I don't know if we can work around it, but we stand a whole lot better chance of working around those things if we know them up front.
That is excellent advice. And I can't reiterate that enough. I mean, just be honest with the people that you have on your team, and they'll know, and they'll lead you and guide you, and find people, whether you're working with a consultant like myself, or you're working with a lender like Geoff's team, find people that you trust, because there's a lot of people that are up to no good out there, and they are looking for the sale or the quick dollar. And you need to make sure that they've been tried and tested and they have a good reputation. So thanks again, Geoff.
Okay. Thanks, Eric.